Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about looking for quick cash. Try to avoid retirement savings. Let's get into the video. If you find yourself looking for a quick source of cash, your retirement savings may look like a tempting option. However, if you are under age 59 and a half and withdraw money from a traditional IRA or qualified retirement account, you will likely pay both income tax and a 10% early distribution tax, also referred to as a penalty, on any previous untaxed money that you take out. Withdrawals you make from a simple IRA before age 59 and a half, and those you make during the 2-year rollover restriction period after establishing the simple IRA may be subject to a 25% additional early distribution tax instead of the normal 10%. The 2-year period is measured from the first day that contributions are deposited. These penalties are just what you would pay on your federal return. Your state may also charge an early withdrawal penalty in addition to the regular state income tax. Thus, before making any withdrawals from an IRA or other retirement plan, including a 401k plan, a 403b, tax sheltered annuity plan, or a self employed retirement plan, carefully consider the resulting decrease in retirement savings and increase in taxes and penalties. There are several exceptions to the 10% early distribution tax. These depend on whether the money you withdraw is from an IRA or a retirement plan. However, even if you are not subject to the 10% penalty, you will still have to pay taxes on the distribution. The Secure 2.0 Act, passed by Congress and signed into law by the President in December of 2022, added several new exceptions. The exceptions may help you avoid the penalty. The first two are new. Exception for terminal illness. This applies in the case of a distribution from a qualified plan to an employee who is terminally ill or on after the date on which the employee has been certified by a physician as having a terminal illness which can reasonably be expected to result in death in 84 months or less after the date of the certification. Penalty exception for domestic abuse. A domestic abuse survivor may need to access his or her money in their retirement account for various reasons, such as escaping an unsafe situation. Retirement plans can permit participants that self certify that they experience domestic abuse to withdraw a small amount of money not subject to the 10% early withdrawal penalty and not to exceed the lesser of $10,000 or 50% of the present value of the non forfeitable accrued benefit of the employee under the plan. A distribution is an eligible distribution if it is made during the 1-year period beginning on any date on which the individual is a victim of domestic abuse by a spouse or domestic partner. Domestic abuse means physical, psychological, sexual, emotional, or economic abuse, including efforts to control, isolate, humiliate, or intimidate the victim, or to undermine the victim's ability to reason independently, including by means of abuse of victim's child or another family member living in the household. A distribution in this case may be repaid at any time during the 3-year period beginning on the day after the date on which the distribution was received. Next, a 60-day rollover to another qualified plan. A taxpayer can avoid both the income tax and the penalty on an early distribution if the distribution is rollover into an eligible retirement plan within 60 days of receipt. Some taxpayers use the 60-day rollover provision as a source for a short-term loan. However, there are built-in hazards for the 60-day rule. One rollover per 12 months rule. IRA rollovers are limited to one per 12-month period. Any other than the one would be considered a taxable distribution unless another exception applies. 20% withholding rule. Another barrier to completing a 60-day rollover is the mandatory 20% withholding of federal income tax requirement when a qualified plan distribution isn't transferred trustee to trustee. Because 20% of the distribution went to withholding tax, the taxpayer only received 80% of the funds and cannot recoup the withholding until filing time. First, they would have to make up the 20% from another source to complete 100% rollover. A distribution from a qualified retirement plan or IRA that is transferred directly by the trustee of the plan to the trustee of another qualified plan or to another IRA does not count as a rollover and does not trigger the once per year rollover limitation and are not subject to withholding. Withdrawals from any retirement plan to pay medical expenses. Amounts withdrawn to pay unreimbursed medical expenses are exempt from penalty if they would be deductible on Schedule A during the year and if they exceed 7.5% of your adjusted gross income. This is true even if you do not itemize. Withdrawal from any retirement plan because of a disability. You are considered disabled if you can furnish proof that you cannot perform any substantial gainful activity because of a physical or mental condition. A physician must certify your condition. Can be expected to result in death or is expected to be of a long, continued, and indefinite duration. IRA withdrawals by unemployed individuals to pay medical insurance premiums. The amount that is exempt from penalty cannot be more than the amount you paid during the year for medical insurance for yourself, your spouse, and your dependents. You also must have received unemployment compensation for at least 12 consecutive weeks during the year. Next, childbirth and adoption. For distributions after 2019, a distribution to an individual is exempt if made during the 1 year period beginning on the date on which a child of the individual is born or the date on which the legal adoption of an eligible adoptee is finalized. The maximum amount exempt from penalty is 5,000, and the amount applies to each spouse separately. Such qualified birth or adoption distributions may be recontributed to an individual's applicable eligible retirement plans within 3 years, subject to certain requirements. IRA withdrawals to pay higher educational expenses. Withdrawals made during the year for qualified higher education expenses for yourself, your spouse, or your children or grandchildren are exempt from the early withdrawal penalty. IRA withdrawals to buy, build, or rebuild a first home. Generally, you are considered a first time home buyer for this exemption if you had no present interest in a main home during the 2 year period leading up to the date the home was acquired, and the distribution must be used to buy, build, or rebuild that home. If you are married, your spouse must also meet this no ownership requirement. This exception applies only to the first 10,000 of withdrawals used for this purpose. If married, you and your spouse can each withdraw up to 10,000 penalty free from your respective IRA accounts. IRA withdrawals annuitize over your lifetime. To qualify, the withdrawals must continue unchanged for a minimum of 5 years, including after you reach age 59 and a half. Separation from service. To qualify, you must be separated from service and be age 55 or older in that year. The lower limit is age 50 for qualified public service employees such as police officers and firefighters, or elect to receive the money in substantially equal periodic payments after your separation from service. After 2022, this exception also applies to private sector firefighters. Emergency expenses withdrawal. The 10% penalty will not apply to certain distributions used for emergency expenses, which are unforeseeable or immediately financial needs relating to personal or family emergency expenses. Only one distribution is permissible per year of up to 1,000, and a taxpayer has the option to repay the distribution within 3 years. No further emergency distributions are permissible during the 3 year repayment period unless repayment occurs. The exemption is not effective until after 2023. You should also be aware that the information provided is an overview of the penalty exceptions and that conditions other than those mentioned may need to be met before qualifying for a particular exception. You are encouraged to contact a financial advisor before tapping your retirement funds for uses other than retirement. Distributions are most often subject to both normal taxes and other penalties, which can take a significant bite out of them. However, with carefully planned distributions, both the taxes and the penalties can be minimized. Thanks for watching this video, and do not forget to subscribe to my channel.